Ajay Srivastava from Dimensions Consulting as well joins in on the show. Ajay, hi, morning, practically there at all-time highs. What's the market texture telling you?
Good morning. I think the market texture is very, very good because what bloodletting happened last week proved to the one fact that fundamentals do count. You got to be clear out of euphoria. Market is in strong hands. Strong players are performing well. The weaker ones, for reason they're called high beta, of course, go up and go down. So in a sense, I think, the bloodletting of last week has given a lot of strength to this market because the weaker players, the weaker stocks have kind of fizzled out. The stronger players continue to perform. The right sectors are getting the right valuations. So all in all, we're going in a very positive mode to the market. And I predicate that whole thing to say that as long as the global liquidity remains, pretty nice and easy, I think we are on a good, healthy wicket as far as the good quality companies are concerned and the well-capitalized companies are concerned. I think the leveraged companies have still a lot of pain to go through and we should leave them aside. But a large block of good quality sectors, good strength in the market, positive flows, positive sentiments, I think it's overall looks to be a pretty good scenario.
So all those fears, Ajay, that perhaps the markets may be reaching the top end of the curve, are they unfounded? Do you see meaningful gains even from the 7,800 mark?
You tell that top of the market to the guy who was in Jayaprakash or was in hundreds of those stocks which lost 30-40% in the last 1 month. They don't feel the bullishness in the market. They lost money. I think the key here is stop looking at the indices, look at the stocks, look at sectors. For instance, look at oil sector. That's a good place to be. Look at pharma. Very good sector. Fantastic results in most companies have come through. So, let's not worry about indices. Worry about the sectors that you are invested in, the shares you are invested in. What's the point of saying I'm in the bull market when the guy has lost 40% in few nationalized banks, in the few infrastructure, etc. That guy doesn't feel the bullishness. I think the right way measure is that are we in the right sector, in the right stocks, and stay by it because I think we are on a pretty good situation right now from the macro front, from the fundamental front, from the policy front, and if liquidity remains good, you've got to remain invested there.
So what are the right sectors then, Ajay? Because the markets have been sort of shuffling between sectors and dodging the ball from here to there with such speed that it's difficult to catch sectors and stocks. And, I guess that's what retail investors must be struggling with right now.
Okay, I don't hold a brief for retail investors because I think they just come at the last point and they invest in all kind of rubbish stocks. I have seen it, the mid-caps, the small caps. Those are not the places for these people who have low risk appetite. But if you look at shuffling the ball, we have not seen a derating of the pharma stocks, for instance. Pharma has gone from strength to strength. If you look at Sun Pharma, look at Ranbaxy, look at even the smaller names like Suven, etc., performance has been good, steady increase in price. If you look at consumers, look at Dabur. It has not seen a fall for last, I think, 2 years. So, it's nice to say that, listen, there are, shuffling of sectors, but you see the strong stocks, they don't fall or don't fall too much. So when you ask sectors, if you look at the pharma, if you look at the IT, if you look at the strong consumer names, they have not fallen at all. You look at the brilliant performance of consumer goods. Look at HUL, was slugging at 580s and all, and has taken a one shot to 700 plus. So I think still the theory remains. India's story is about large caps, well-capitalized companies, maybe a few select mid-cap names in a select pharma kind of a sectors, and that is where you park your money. It's not volatile. It's a one-way street for these stocks.
Earning is predictable and so what, they're expensive. Ajay, I'm with you when you say that one should focus only on large cap stocks. However, the basic thesis of this bull market is that the new regime will change the economic environment, business houses will be fixed, leverage companies will do better. So what happens to the core thesis of this market, which always is about focusing on cyclicals?
Of course, leverage companies are feeling better. Let's take Jayaprakash, Lanco and GMR, 3 names. What should be the actual share price? Should it be less than 10 rupees? So is Unitech and DLF. They should not be even quoting above par, if you ask me, because that is the leverage position of these companies, net of their asset value, and you've seen the divestitures haven't got a great premium. It's been a desperate selling out there of assets. So, with the fact that Jayaprakash quotes at 60 rupees or a Lanco quotes at 15-18 rupees, is itself to my mind a great premium given to these companies. These companies should be below par and for a long time because liquidation value of these companies is below the net debt value.
Ajay, you've said Jayaprakash at least, half a dozen times already. Looks like you have a big short position there.
I wish I had. We closed it, so we don't have it anymore. You know, in a crazy market, I keep telling my guys that, market can remain irrational, old phrase, longer than you can keep me solvent. So leave that aside. There are a lot of irrational players who are in the market who can beat you. Unfortunately, this is not a great market for shorts. We lost a little bit of money on shorts because it doesn't matter which sector. It suddenly goes up and for 15-20% and you lost hell of a lot of money. So in a booming market, I don't think shorting is a great strategy. It will lose money. In a normal market, they were great shorts at 80 rupees. They're great shorts at 58 rupees.
Ajay, you mentioned that you like oil marketing stocks, but within the oil marketing space, there are three options: HPCL, BPCL, and IOC. And all these three OMC companies have different dynamics. So which one do you like?
Well, we have a holding for disclosure purposes. We took a holding in both BPCL and IOC at this point of time with a larger proportion to BPCL for various reasons in terms of pedigree, performance, in terms of a cleaner balance sheet and structure. We like BPCL better. And IOC, of course, because it has spreads across a wider spectrum compared to the size of BPCL. So these two stocks, I think, would be a right place to be in. And because oil exploration, ONGC, it's a tough call because the oil prices are going down. What happens to it, I don't know. But it could be a wise to get into ONGC at some time. But today, oil marketing companies, BPCL and IOC would be a better bet.
Ajay, what are you liking from the auto universe? FI interest has been pretty high. Stocks have been on a tear and earnings as well have been supporting the moves.
See, it's been a difficult call in auto, to be honest, because I think barring Tata Motors and Mahindra, we couldn't identify anything much we want to buy. Maruti has been zigzagging up and down, so it's kind of not giving very good returns to the capital employed. But these two, I would still say, Mahindras and Tatas would still remain a longer-term bet to us in terms of 20-30% return on a 6-month or 8-month period compared to other stocks. Two-wheeler again is getting a lot more competitive. You should see Hero Honda going up again further with the export looking better and so I would still say that Tatas and Mahindras and maybe Hero Honda would be a trio that you want to bet in the auto stock.
So Ajay, if we have to chart the market course, let's say from here till Diwali, which is middle of October, what kind of market trajectory do you think we are likely to follow or we could follow?
I think we'll follow an upward trajectory, and I say with a caveat that assuming the global events do not kind of disturb the equilibrium of easy liquidity supply, if that remains so, I think the trajectory is up, and the trajectory is pretty well up for the bigger, well-capitalized stocks. I think there are differentiation. It may not be so for the smaller mid-caps, highly leveraged companies, but for the bigger, well-capitalized stocks, I think trajectory is well up to 20-30% return by Diwali from where we sit today.
There's been a price and volume breakout on Unilever right now. 2.5% spurt is what you've seen on Unilever, and almost good amount of shares as well. Just to start off the trade with, good amount of volume spurt, that is. 732 is where the stock is right now. I just want to see what the Bank Nifty as well is up to right now, and the Bank Nifty should come up for you on your screens as well next. The Bank Nifty and how has that started off trade? Let's see what the Bank Nifty is up to. Absolutely flat. That's the sense that you're getting about the first ticks on the Bank Nifty futures at 15,100 thereabouts. Ajay, what's the sense that you're getting about the move on banks, especially the PSUs, considering they continue to be marred with asset quality stress, and that is, pretty much been inevitable or rather very evident in the first quarter earnings?
Don't ask me. I think Nikunj has to answer that when he said, why did you mention Jay Prakash? Which bank gave them 65,000 crores on an equity of 12,000 crores, 5:1 debt equity? Who is the one who gave them? It's a nationalized bank. Who is the one who gave Lanco 40,000 crores? That's the one. Who gave GMR? These banks have no transparency. You don't know what they're buying. Yeah, there could be speculative buys, but they're not investment buys. And Bank Nifty is held by, 4 stocks? HDFC Bank, ICICI Bank, Axis Bank and State Bank. All good, I think, to buy, in my view. But the Bank Nifty, whatever they gain up, I think National Bank will give way. So movement of Bank Nifty is very difficult to visualize. I don't think they will outperform the bigger segment of the market, in my view, in the next 6 months. I think they will remain an underperformer relative to the other sectors of the market.
Well, IDB has extended a credit loan of about 1,000 crore to Kingfisher when they had a negative net worth. That's shocking, and it's quite amazing. So let's talk about the good part of the market. The good part of the market, according to you, is IT and pharma and private banks. Now, the challenge, Ajay, for the good part of the market is that for most of the good stocks, the FI limit is almost frozen.
And don't forget I would still say the telecom space. I think the two names that Aisha mentioned, very good strong buys. See, I still think the government is going to liberalize a lot more policies as they go down the line. I don't think so. The caps are going to remain for very long. It's too early to say. And I think much more liberal regime is on the way. I don't think that is a consideration one would follow in terms of whether buying decisions for Indian investors are concerned. You would rather stay invested in better quality stocks and expect policy liberalization to take place. I don't think so. We are not going to see more increased FI buying, more increased limits, more increased capital coming in, because that's given. If the new auctions come in, you've got to raise money at the end of the day. So which means you have to increase the limit for telecom companies, for instance. So I think that's a given. It's a matter of time, and I think that's where you're betting your money on, as saying this government will liberalize foreign investment in this country, in these sectors, but that's where the money is going to come from. So you bet on that rather than betting the reverse, saying that there will be a constraint on these sectors.
Okay, fresh.
See, an idea, the two stocks that I would like to mark out, considering that's what Ajay was talking about. But Lupin as well, and pharmaceuticals has been a strong pocket. Lupin is giving you a very good price and volume breakout, a 1% uptick coming in on Lupin. 1194 is where that stock is currently sitting at right now.
Ajay, you mentioned that you like pharmaceuticals, and again, pharma is not an easy space to understand. What do you like within pharma? Do you like generic companies? Do you like MNC companies? Where are you placing your bets?
See, certainly not MNC companies at this point of time, because MNCs have not really invested in any state-of-the-art drugs, and they have an exposure to only the domestic market, the price control segment being a large portion of the sales. I think you have to really focus. There is no prizes for guessing, Nikunj. Just close the blind, put a blindfold, and you can pick up the Sun. Aisha should be sitting here actually. She's been talking of all the names that you want to invest in, right? Lupin is the second one sitting there. In the smaller categories, you have very nice companies like Suven. Biocon had an indifferent performance. But I think I would think it's a good buy at about 430 odd, because they would spin off, I think, their parts of their companies into different companies, so you get a good windfall gain there. So, across the spectrum, what you don't want to buy, and I think it's very important, is the pure bulk drug companies. You don't want to buy a pure domestic small APIs for one reason, that when we look around the market, Nikunj, and we'll do the due diligence on most of these companies, you find lots and lots of accounting irregularities, including fake billing in most of the mid-cap and small-cap pharma companies in India, trying to scale up their revenues to get investors in the company. That is why you want to be very clear that 60% of the bulk drug and API companies in the mid-cap and small segment have an issue with their accounting on sales. So you want to stay clear. Stay with the big guys, stay with the performers, stay with companies like Suven, which have a strong portfolio of products in their portfolio. Just don't go for generics only, because that's not going to give you all the mileage. You got to go for the guys who's got some IPR sitting there. So you got Glenmark, you got Suven, you got even Sun to an extent, and of course Divi stands alone as the king of the manufacturing sector. There is nobody close to Divi Laboratories. So I would say it's a no-brainer to invest in pharma, given the 6-7 names you spoke about.
Cipla, they came out with good set of numbers. Is there any reason why you don't like Cipla?
In very indifferent performance over the last 4 or 5 years. If you look at the relative performance vis-a-vis the sector and the major players, you would find that on all parameters, sales growth, profit growth, margins, Cipla has been an indifferent performer, and to an extent also maybe volatile performer. Now, if you're getting a good quality company with a consistency of performance, why would you want to buy Cipla at this point of time? So I would rather allocate capital with a proven record with IPR benefits. Cipla does not fall in that category. It is not the blue chip of the pharma today.
So, I mean, Ajay, there's got to be something that you do like in mid-caps. You've talked about, pharmaceutical names like Divi's Labs. But what about the likes of a Jubilant FoodWorks, or for that matter, Cox and Kings? Consumption plays where earnings are getting better, and we've seen how battered these stocks have been. So, there's only sort of one way to go, and that would be upwards.
I don't know that is correct or not, Aisha, that one way to go upward. because these are stocks which are highly risky, and I keep saying to myself, in spite of being in the market for years, I have not seen this segment outperforming the bigger stories in the market. And it's a paradigm which you don't understand. It's a contradiction in terms. Theoretically, they should give a better return. But I would still say, let's take the name Jubilant Foodworks. It's run its course. It's not a cheap stock. At 1200, it's really expensive in a company where store sales have been contracting. The competition has gone up, the prices have gone up, the cost has gone up, and each store sales have contracted in this year. So, yeah, they're good stories, but they're not the stories that you want to bank your money on because they're too risky at this point of time. And I would say to you, for instance, why would you not put your money in Sun, where Ranbaxy merger is about to happen and is going to create a Goliath of a giant in the world of pharma versus what you just say, Jubilant, or even, for instance, Cox and Kings? Where would you rather park your money? I would tend to be safer and say, park the money with Sun and Ranbaxy rather than other companies.
Ajay, what happened to your position in IVRCL?
Do you have to remind me of nightmares in the morning?
So you've exited IVRCL?
No, I think we have a small holding. I think by and large we exited, but we have a still small holding for sentimental sake. Very, very small. It's minuscule actually. But it's good fun to see it once in a while.
So what could be a high risk, high return idea? Because whereas 80% of your portfolio, 90% of your portfolio maybe is aligned with quality stocks, it is aligned with companies which have good visibility. I'm sure 10% is in some of those high risk ideas.
Yes, we have. I think we have a very large exposure to, may call high risk, Reliance Infra, for instance. We have been building our position with the correction again. We had a position, we sold out for customers as well. We are again building it up at 700 odd rupees. I think it's a great story out there. It should give a very strong return. We are again back to liquor. We sold out in the open offer. We are again back buying at 2300 United Spirits. I think these are the kind of stocks we are banking upon. As I said, Suven is one. We have bought quite a bit in that, and that we continue to hold. Very risky stocks. We have Havels in our portfolio, which continues to hold. But very risky stocks, I don't think we have much in the portfolio at this point of time. I can't afford losses.
Say that Havels is a strong company and there is nothing risky about it.
See, I think it's risky because one, it is expensive, let's be honest. Number two, is in a very competitive space, there is no doubt about it. And the third part is that it's quite a bit linked to the growth in the housing sector and the basic economy, where demand has not exactly grown in the order that we see it should be growing compared to the economy. So three big risk it runs: being competitive, not easy to distinguish your products there, and the demand is not exactly galloping away. So three high risk, but the fact that he's consolidating market share and he's becoming the true leader in the country gives you credence that it's a good investment buy with all the risks that are attached to it. And the risks are high, let me be no doubt about it. Risks are very high in that for a company.